about to get started again. We have another great panel coming up because we talked about asset management. We talked about even the future of it and what it could look like when it comes to vault structures. But there's something to be said about institutional DeFi participation. April was not great because of exploits. In terms of getting institutional adoption and confidence into DeFi technology. So there is something to be said about managing risk, being aware of what's out there. So we are putting together a panel on curation, using DeFi technology for asset management and institutional use cases, risk management as well, and specifically for institutional use case. So with that, please welcome up Nick from Gauntlet, Jeff from Newton, Alex from Aeon, and Mike Massari from Credora and Redstone itself.
That was rousing.
I love the epic music for intro. Nice to see everybody. And I hope you're doing great. I'm Mike Massari, Head of Partnerships at Redstone. Thank you so much for being here. We really appreciate you all being here with us today. I have a pretty good panel, I think, with excellent guests. And we're going to talk about, as Jeff said, we're going to talk about curation. We're going to talk about risk in curation. I would do the usual thing that people do in panels. So ask my guests to introduce themselves briefly and tell us a little bit about what you guys are working on.
Awesome. Thank you. Alex Krasnow, DeFi lead at Aeon. We are building out risk control standards and insurance products for vaults. So excited to dive into the work that we're putting in.
I'm Jeff Marsilio. I'm head of commercial at the Newton Foundation. Newton is an authorization layer. It checks your policies before a transaction can settle. Those transactions could be RWA transfers. They can be vault transactions. And then it enforces those policies in a way that others can verify.
Nick Cannon, leading business for Gauntlet. We've been around since 2018 as the leading risk and optimization firm, managing roughly a third of DeFi assets and increasingly a few $billion in vaults.
So I was saying, let's start maybe a bit high level. And let's start talking about what DeFi has been so far and what we've been doing for the past few years, which was very much focusing on the upside. DeFi has always been about APY and how much you can earn. And we didn't really think about too much historically on how much you can lose and what are the risks. And obviously now with institutions coming on chain more and more, this is becoming a central topic and a central conversation. And you tackle this problem from different ways. So maybe we can start by saying, how do you price the yield on the Gauntlet side? How do you understand what are the risks of curation and therefore construct markets that are with a certain specific risk profile?
Everything for us is just how we bound the tail effectively. Historically, it was one size fits all. In order to get traction on chain, there was a peer-to-peer model that started 2018-19, and then network and liquidity effects just weren't there. So the lending pools took off, the Aave and compounds of the world, and then you have cross-collateral and cross-margin, and that gets extremely complex to one size fits all. And the default there is you get extremely conservative on a risk profile because governance moves slow, it's token governance, and a variety of other factors there. In the past couple of years, as we've been able to isolate with immutable code and get a bit smarter about both smart contracts and economic risk, been able to tranche out and start to look a little bit more like traditional finance. But very much for us is how we can measure that tail, as mentioned. And a lot of that is around liquidity, and not just vanilla liquidity, as you would think, on-chain and the blocks that could get printed on exchanges or similar, but every sort of redemption path, 1, 2, 3 steps, both on-chain, off-chain, mint, redeem, and in issuers and custodians on exchanges and similar. And that is very much, as you can imagine, not static. So that's hopefully where we add the value to the assets that are trusted within our structured products and elsewhere.
Yeah, and then on another angle, Jeff, like on Newton, what you do is effectively enforce policies and create policies based on this risk data, right? And based on data that comes from on and off chain sources. How does that mitigate the risk factors within?
Yeah, that's right. So folks like Gauntlet have, over the years, they've defined countless parameters and rules and processes to constrain risk, or at least identify risk and place limits around it. What Newton does is turn those into rules that can be enforced on-chain before a transaction settles. Those risks can be compliance related, so it can be just checking to make sure we haven't accidentally taken in funds that fail OFAC compliance. They can be rules around security to see whether the protocol that we're about to place our trust in is still a safe place to place our trust. And they can be financial risk policies. They can be things like concentration limits. You mentioned, of course, credit ratings. Credora takes in hundreds of inputs and creates an incredibly sophisticated rating about assets, vaults, markets, protocols. But that data is useful as a sort of an inbound monitoring signal. It tells me when to take an action. But with Newton, we turn that into a policy. You have to check Credora before you can make this decision. So we are taking the intelligence that folks like Gauntlet have developed over many years, since 2018, as Nick said, turning that into rules that must be enforced, and they're enforced on chain in a way that others can see they've been enforced, so they're verifiable.
And at Aeon, effectively, you take on everything that happens after, right? So when you manage to like the price and ensure and make sure that everything is correct, you just created a consortium. Tell us a bit about that, Alex.
Yeah. We're not going to cover absolutely everything, so I'll preface that. You know, we'll cover as much as we can. You know, in the last year or so, as you know, insurance has been trying to grapple with vault-level liabilities and how regulated insurance products can cover them. The challenge has been the premium rate eats too deeply into the yield for this to be financially feasible for anyone. Frequently 5 to 7% premium on any vault product, which, as you can imagine, I was laughed out of quite a few rooms in the last year. So we've built a consortium comprised of 30 of the most predominant players in the DeFi space to play a few roles, but most importantly, align on the first consensus of risk control standards for vaults that can be deemed institutional and strong enough to qualify for a cost-effective DeFi vault insurance program that we're putting together. The second piece of that, which goes hand in hand with the creation, is the education of underwriters. As they try to grapple with this, it seems every week or every few weeks, there's a new use case, which unfortunately are exploits in my sector. So this has been really exciting. Fortunate to have Redstone, Gauntlet, and soon to be Newton as well as part of the consortium. And we hope to have scalable, cost-effective DeFi vault insurance products ready to go in the next 3 or 4 months.
It's a really fascinating signal, though, isn't it? If they're telling us, the experts in risk are telling us this is what it costs to insure these vaults, there's some sort of a mismatch. And we need to get a handle on the mismatch and constrain those risks. So I learned about the consortium half an hour ago, and my application is already late, so we're definitely going to join.
Excited to have you.
So it's interesting, right? Because this consortium makes, as you said, these 30 biggest players in DeFi work together. And I'm curious on how you see the evolution of this working together happening, right? Because we're all tackling similar problem from a different angle, and ultimately the objective is to make it as easy as possible for institutions to tokenize on chain and also as safe as possible to tokenize on chain. So the question for the group, and whoever wants to take it, please do, is how do you see those risks being mitigated by multiple angles? We're moving away from a single company trying to do everything, but we're moving into like DeFi partnering as a whole to solve a bigger problem. How do you see that happening?
You know, the way that we look at it, without getting, you know, company or entity specific, is it's frameworks and it's standards. It's multi-sig standards, it's incident response standards, it's governance standards that can be repeatable regardless of if you're the curator, the allocator, the protocol, whatever that may be. And I think, you know, on those standards, what's most important and what I like to share, any chance I get to speak about this, is what is your incident response plan if there's an exploit in the middle of the night and you have a multi-sig framework and one of those signers is asleep in a different country? What's the conversation there? I can talk about this all day. That's a lot of what the consortium will decide, but that's the way we look at it. Let's set the standards. Let's have some agreement on as many of those as we can, and then we can educate carriers on the differentiators between the different firms as they progress and learn more about this.
I think there are two ideas at Newton that contribute to what you're describing. The first is the idea that a policy can be a primitive, kind of like a smart contract, that it can be reused over time, that it can be hardened, that it can even develop and earn a reputation, and that we can share it and then even reference each other's policies. Like, imagine if my wallet said, you just cannot move funds into a vault that doesn't itself enforce a Credora-powered policy. Right, so now it's this self-referencing network of policies. That's one idea that we have that we think kind of hardens the whole system and spreads out responsibility and turns policies into something more like a public good. The second idea is that a credibly neutral network can enforce these policies, that operators can participate and have economic security that ensures they do so honestly and with integrity, so that it isn't entirely on you to enforce your own policies, and then third parties don't have to just trust your word. They can trust the network of people participating together to make sure this is being enforced and that our vaults and our financial products are safe. Those are two ideas for how we can kind of share responsibility together in in the security of finance on chain.
For 7 or 8 years now, I think every year someone inside of our org, sometimes me, has made the ambitious, naive, and rudimentary attempt to have some kind of standard or ratings to publish when we see a report or a tweet or a blog post or whatever it might be get it wrong. And we're quite opinionated, and we are very happy that there's a maturation of hopefully this sector where we don't have to bite off more layers than we can really chew. We need standards. They can't come from us. We can't rate ourselves. It's not particularly credible. It's not particularly credible to kind of don't trust, verify us because we say so. We're, of course, hopefully historically that people have. We're trying to build a brand. We're trying to build a company that vendors and users and everyone else can historically trust. But we very much have, as we've seen on chain today, reached somewhat of a plateau or a ceiling. However you want to say this risk is priced, there is some ceiling of how do we get that next cohort to adopt whatever you want to call institutional. Is it banks, asset managers, whoever? There needs to be a new unlock, and that first comes with more build-out.
I always use the Obama meme example. I don't know if you saw that, when Obama gives the medal to Obama when people rate themselves. It's like, don't worry, my product is the best. But no, it's very true. And like, we're trying to create standard, and I think as an industry, not only as Credora. But at the same time, there is, as you mentioned, Jeff, trust. And so, for example, Gauntlet has got a phenomenal name, I would say, in the curation space. And there's a lot of people that obviously come to Gauntlet for risk curation because of the trust that they put in Gauntlet and in the brand. But you do have a very strict due diligence process, right? So you don't just work with anybody. You have your own standards and your internal rules. Take us a little bit about how that works. What's the process of determining whether or not an asset can be tokenized and can be actually supported and curated through Gauntlet or not?
Luckily for everyone here, it's a bit of a black box sometimes even to me. I'm obviously on the business and commercial side, so it's quant-led, it's risk-led. There's 25 to 50 factors that are upfront diligenced. We very often ask partners that are someone's bringing us a stablecoin or an asset to tokenize how you approach these, a variety of liquidity to governance and demand and a number of other factors. And then a lot that we backchannel and don't disclose to them as well. And that first informs how we list and take it to market, and if we do or don't. Ratings obviously play a factor, but the primary factor they play today is that standardization. Will this grow demand? Or does a rating, Credora, S&P, Moody's, however, help the demand of that cohort, give credibility to this vault, this market, this structured product, that people will come use this thing? There's obviously scalability, and we can spin up a number of financial primitives on chain pretty quickly and easily, but there's kind of no point to add that surface area, that hack risk, that cybersecurity risk if no one's coming. And so that's roughly how we think about it to start. And then it's this painful, ongoing 24/7 Saturday night process to make sure all the monitoring, ETLs, trading operations, and incident response, as you kind of mentioned, are always on. Hopefully the demand follows as well.
And obviously this is evolving, right? So there's 25 to 50 indicators. Now there's a lot of, I'm assuming, manual or semi-automated process of verifying this indicator and then finally an asset get listed. But then obviously assets evolve over time and they can change over time. So in terms of automation of this enforcement, right? How do you see that happening, and how do you see that modifying the way that we think about, for example, vaults in DeFi?
Are you looking at me?
Yes.
Well, a lot of what Nick just described is a black box for at least two really good reasons. One, because the more you reveal, the easier it is to game the system, I would imagine. I'm guessing, but you're nodding, so that's good. And the second is because you develop, and this is a lot of what is proprietary to Gauntlet. This is a lot of why people do trust Gauntlet. We don't expect Gauntlet to publish its entire strategy and all of its alpha as readable policies in Newton anytime soon. We do think that we can help even Gauntlet by helping them to publish some of the guardrails, some of the constraints, and do so in a way that is automatically enforced, and again, verifiably so. With Newton, you could also choose to encrypt those policies so that only you can read them. They're still enforced automatically. They're still verifiable as to whether they were enforced, but you wouldn't know what was enforced unless you also had access to those private policies. So we can go a step further. But we also think about the extraordinary concentration in DeFi. I mean, you mentioned just how dominant Gauntlet is, and I don't think Nick is going to complain about that. But wouldn't it be great if there could be even more gauntlets? But what Nick just described is not practical for the average manager of investments. I don't know if we're allowed to even call them that, or curators of risk. So part of the question that Newton exists to answer is, how do we democratize this? How can there be many, many more gauntlets? And automating more of these processes, making them more open, making the policies more portable, contributes to that democratization. And then as you have more participants, you maybe have more innovation through competition, and the space is safer even still. That's how we think about it.
Yeah, and I think that obviously this is evolving over time, right? It's not only from an infrastructure perspective, but sometimes also from a risk financial perspective. So, for example, insurances in vaults or for certain positions were not particularly popular some time ago. It's something that is relatively new in the world of DeFi. I did some research on this. But I would love to know from your perspective, Alex, why this is important. Why it's important to have insurance, and how the job of the insurance kind of changed over time as more tokenized assets came on chain.
I think the way that insurance has changed the most is it's moved in a sense from protection from your worst case scenario to a sense of proof of effective risk controls. We are not looking to insure every vault. I make the joke often that I think there's going to be layers to coverage and how vaults work. I think where we're offering kind of regulated, rated, AM best rated insurance, that'll be the tier 1. The tier 2 being the on-chain risk transfer protocols, the Nexus Mutuals, the open covers of the world. And then the tier 3 being the 30% yield, no clue where it's coming from, not getting any coverage, all power to you. And so that's the evolution is I think, as insurance was first learning about this space, it's cover what we can, and now it's enforce what we can as prerequisites for the right coverage.
Does it mean that every single vault will need to have an insurance, or does that mean that instead it's more about picking and choosing where it makes the most sense?
We just want to add optionality. We're not taking away, again, the 30% yield options. As we have conversations with every major institution looking to allocate, it's going to be kind of a currency of business is having the insurance in place. So yeah, we'll have our sector, and then we'll leave the rest to the investors who want to take on certain risks that we're not willing to cover.
Yeah, and I think that there's still obviously undefined risk. So we talked about obviously risk from like 3 different angles here, but there's still gaps. And there's a lot of stuff that institutions, for example, expect from chain, or even blockchain expects from assets that are listed on blockchain. What do you think, also question open for the group, is the biggest, or a few of the biggest gaps there, and how can we bridge that and come closer together?
Yeah, I can jump from the insurance side. I think it's a unique structure how we're going to be insuring DeFi. Ideally, one policy, one insured, one entity would cover the entirety of a transaction. It's just not feasible. The way that we are structuring these programs is you'll have a vault-level insurance policy that covers the vault-level exploits, the smart contract, the oracle manipulation, the oracle failure. In insurance, there are aggregate limit concerns among carriers. Every carrier is only covering a risk X amount of times. So if we had 50 Morpho vaults and told them we would like protocol level coverage as well, they're going to run out after 5 or 6, and the rest of the 40, 44, 45 have no coverage. So we are really piecemealing in to try to cover those gaps. I would say today it's really dependent on the entities you work with and the specific coverage that they have, and beyond that, the specific coverage that they recommend or require of their partner entities. So today, I think we start at the vault level, we cover the protocol level. There may be some gaps in relation to bridges. There's going to be market level gaps. We don't insure that today, and that'll evolve over time.
There are so many gaps we could probably just dedicate a day worth of workshops to it. And I don't mean that to sound scary. I think that DeFi has come a really long way, and now we're dealing with edge cases. There are just a lot of edge cases. So DeFi is safer than ever, but the stakes are higher than ever, and that is revealing just how many edge cases there can be. Part of that is the incredible connectivity of DeFi. There are so many Lego bricks. And part of what happens is a risk that would be contained in the traditional finance world can very quickly and even automatically cascade. So one of the gaps that I think about is what happens when something goes wrong and a loss has occurred, but there are automated processes that are just piling in on the loss. If you look at some of the really big ones, Resolve and Stream and even what happened over the weekend, you see that there was an initial loss, and then there was just a kind of a piling in after we should have known better. In fact, after monitoring services were kind of firing off alarms. So at the risk of being a little redundant, if you can take that useful data which exists and enforce it before one of those pile-on transactions or all of those piling-on transactions occur, then you stop the cascade, even if you didn't stop the initial loss. And think about what this cascade begins to look like when all of this starts to go from, maybe some bots and some humans to agents, agentic finance. What does that look like when they're moving faster than we can think? I think those cascades could really, really get out of control unless we put the controls in place that prevent it from being possible. That's why we're so focused on enforcement pre-transaction.
I guess I agree on a lot of gaps. The edge case that's top of mind for me is we've seen some hacks this year is we spent a lot of time in the past 5, 6, 7 years trying to get visibility and transparency on chain. There's code. If you put enough quants and eng at it, you can decipher that code. You can get all the pipelines you need set up and plumb that into models and have some pretty good visibility into on-chain governance, what parameters are existing, changing, how you will respond against them. But as we all try to grow and expand into new markets and tokenize things that are off-chain, what you realize, especially when a hack occurs and there needs to be resolution, is you didn't have visibility into that governance, that Cayman Foundation, those side letters, the Creditron chain. And that's where we're backing into, thus a lot of the factors in our due diligence and similarly, that this is where a lot of the recent growth has been, but also related a lot of the hacks and those resolution processes are not mapping particularly well to the expectations of users that are coming on chain. They're coming on chain for the efficiency and the speed and cross-border, but when you need that resolution, it's completely broken. And while DeFi and on-chain contracts are getting hardened around that, and hopefully we'll be the first to do so ahead of traditional finance, still we need to close that gap quick.
Well, it sounds like via us, we'll close a lot of those gaps of defining the standards, verifying the standards, and enforcing the standards. So the risk control gaps, hopefully, we can work on a little bit.
I think you raise a very interesting point around the gaps that are not as much as the smart contract level anymore. We're not seeing a lot of smart contract fails or protocol fails. Nowadays, most of the problems are on the interface level. So there's like operational security or there's just like interface issues. And I do think that institutions really want to optimize on that interface, make it as easy as possible. A lot of the time, institutional, traditional finance people, they, rightfully so, I would say, don't want to get into the nitty-gritty of what is a wallet, what's this address or that address, or bridging or slippage, or all of this nitty-gritty. How do you think this interface of DeFi evolved over time, and how do you think that mitigates some of these risks? Because obviously having to issue a transaction manually or click on a button manually or sign a transaction is much more risky than some of the automated process. They are more regulated.
Yeah, I'd say, I'm a broken record with these risk controls, but really, I think we're learning more and more through these exploits that your risk controls are only as strong as your partner's risk controls. And so I think that to me is the evolution of the requirement of these standards. Again, same thing, that we hold everyone to.
One way to think about it, I just remember when I joined as on a personal basis, blockchain, making investments in DeFi tokens, and just hearing about all of the promise of the smart contract and how much it could automate. And part of the story that you described, smart contracts have hardened, but a lot of the complexity that I think we expected to be part of the smart contract, we have now moved on from the idea that it could necessarily be inside the smart contract. Just practically speaking, at least in the Ethereum universe, you have gas limits that constrain the amount of logic and how you can access data, how fresh that data will be when you use it. So there are just constraints to how we use smart contracts. So smart contracts have gotten better at what they do and maybe a little bit narrower than our idealism from a decade past. And those processes that we wanted to be in the smart contract still exist, but now they exist, as you said, in interfaces, in backends, in legal documents, as you described, in processes, and in human brains. Bringing those processes that are now outside the smart contract back in so that we know they're being enforced and that they're being verified is one way to address it. If you look at, I mean, I think this is what you are directly getting at, Mike, but if you look again at the exploits over the last several months or even couple of years, largely they are not protocol failures. The protocol is doing what it's supposed to do. Even in those cascade scenarios, everything is following its programming. It's doing what it's supposed to do. But some off-chain process broke, and then the automated processes were too rigid to recognize it, and the failures and the losses mounted. So we need to not settle for off-chain enforcement. We need to enforce our rules on-chain in a way that we can all verify is happening, and we need better and better and better data to do so, and that should close a lot of these gaps, I think.
I think we also can't settle on the interfaces. We're using Web 2-like interfaces, web app, mobile app. These are just the wrong interfaces for what we all think is a new technology and a breakthrough technology. We're kind of backporting, or as needed maybe, for adoption, Web 3 to Web 2. These are very much the wrong interfaces for agents. They're very much the wrong interfaces for institutions. Institutions will have that control plane. I was at Morgan Stanley Monday, and the head of digital assets is talking about they still have to build a control plane for all of their vendors in between. They're still building their own middleware, and they very much need their own interface because of the problem that they obviously see that exists today.
Yeah, I completely agree, and I think that especially what you said, Nick, is very relevant. So we're still approaching this problem from like a Web 2 perspective in certain fashions, and I do think that also we are learning, for example, how to price correctly these assets on chain. And I'm just gonna, in the next 4 minutes, ask you some maybe controversial rapid fire questions. Do you think that now we're pricing things correctly on chain, given the fact that we have not looked too much into risk so far, and we're just now starting to bridge these gaps? We're starting to have insurance that helps obviously with the pricing to begin with. Where do you think we are versus where do you think we should be?
Yeah, the insurance answer is brief. Every other industry that insurance covers has 300 years of actuarial data, where we have 5, maybe. So it's a different structure. We are not using standard actuarial models for DeFi today. Right now, it's a little bit of a unique approach of, again, aligning on certain standards and hoping that we can educate carriers and get them to a level that they're comfortable with. So a little bit of a weird answer. When you think of insurance, you think, math and pretty repetitive structures, but unique situation that we're in this new industry.
These guys are from 2 different angles, the professional risk pricers. So I won't try to answer too directly, but I will say that I think there are 2 kinds of risk that are really difficult to grapple with, that are maybe exaggerated in blockchain and in DeFi. The first is the one I've been talking most about, which is that even when we've got great processes, they are, at the moment when they matter most, not enforced. So enforcement risk is this kind of meta risk. And then the second is the second order effects, right? There's so much interoperability that's so fast, so much faster in many ways than traditional finance. It's very difficult to place boundaries around the risk in order to price it, I would think. But I think that we're closer than we've ever been before, and closer than maybe those of us who struggle with it every day think we are. And I'm excited. I think that, like, in some ways, these losses are the signal that we need to indicate that it's time to build and invest heavily in the infrastructure that places control on risk, and that institutional capital is telling us this is what we need to move beyond an experimental phase and really move trillions on chain. And I think as an industry, we're doing that, and I think we're gonna surprise ourselves with how responsive we're able to be.
It's definitely closer to the true price of risk-adjusted yield that it's ever been. A lot of which because of consolidation, a lot of which because of the shrinking markets, but also you've reached a ceiling of the existing cohort that wants to allocate, whether it's retail or the global south or whatever you might be, it's obviously incorrectly priced for institutional adoption, and that's where we're going to have to build new things.
All right, last question for you all, and thank you so much for your time and for being here. This was a great conversation. Are you bullish or bearish that a year from now in 2027, we will more prevent risk to happen on chain as opposed to discovering risk events after the fact?
I hope via insurance. We are only a few months away, so I'm very bullish. We've got a great team at Aon dedicated to moving the needle forward. So hopefully less than a year, but very bullish on what the next few months could look like.
I'm bullish, but I'll say that I'm also bullish that the market will be better. And I think when the market is better, there will be more innovation and it will introduce more kinds of risks. There will be more players. And so whether we like it or not, in other words, it will be more varied and more democratized. So we need systems that scale in order to feel bullish about the controls working.
I think open source systems like we're all building here will get hardened first, and that's super exciting, although painful. And hopefully a year is all it takes to do so, and then we can kind of front run all the other industries and sectors we're trying to disrupt.
All right, thank you, everybody. Please do come find us after the panel if you want to talk with us. And thank you for your time, and thank you, guests.
Thank you.
Thanks.
Great session there. Before we head out to lunch, a couple of different things going on. If you missed the workshop first round, there is another